Lai Yee is provided the following information. There is some information given. Profit from operations before bank loan interest is 36,000. Basically, this is operating profit or the profit which is before interest. So normally we are given profit after interest, that is profit for the year. If profit specifically mentions that it is before interest, or it says that it is profit from operations or operating profit, so this is before interest, we need to deduct interest first in order to get profit for the year, that is net profit. Then we have capital figure 200,000. Then trade payables, also known as creditors previously, trade receivables, also known as debtors previously. Then we have 8% bank loan. Then bank balance, if it's debit, that this means it is an asset. If it is on credit, this means it is an overdraft, that is, it is a liability for the business. Then we have closing inventory, cost of sales and revenue. Now, what do we need to find? We need to find some of the figures. Firstly, we have gross profit to sales percentage, that is GP margin, and we need to calculate to 1 decimal place. Then we have net profit to sales, that is NP margin. Then we have ROCE, return on capital employed, also pronounced as ROCE. Then we have current ratio, also known as working capital ratio. Then we have some theoretical requirements as well, so as to interpret what these ratios means. Now you must keep the question on a separate device so that you can refer to the question whenever needed. First requirement that we have, we need to calculate a GP margin, gross profit to sales percentage. Now my dear student, the formula is gross profit divided by sales multiplied by 100. So as you can find the gross profit in this question, no, gross profit is basically not given, but we can find it easily. How? Gross profit can be found by deducting cost of sales from the revenue figure. So revenue is basically sales, and if we deduct cost of sale from sales, we'll be getting a gross profit. So 600 minus 480 divided by again sales. Why? In the numerator we have a gross profit, but in the denominator we have sales revenue. So gross profit divided by sales revenue, again 600,000. Because we need to find a percentage, we need to multiply it by 100. So if I solve for this, the answer would be 20%. So there is no need to worry about the decimal now, because it is coming in the whole figure, 20%. Now what does this 20% means? 20% means out of $1 sales, 20 cents is my gross profit. Okay, so the gross profit that I am earning is $20 on each $100 of sales. The more there is the gross profit, it would be better for the business. Then after gross profit, we have a net profit percentage known as NP margin. Formula would be net profit, that is profit for the year. We'll be using profit for the year and divide by sales. So how can we calculate a profit for the year? It is easy. If we deduct expenses from a gross profit, we can easily get net profit. So this is one of the way to calculate net profit. What is it? Gross profit minus expenses. But as you can see in this question, expenses are not there. So I will be using another formula, and that is, I have been already given profit before interest, that is operating profit. If I already have profit before interest, what I need to do, I need to deduct interest from this figure. So how can we calculate interest? Interest can be calculated on the loan. We have a loan of 100,000, and if I apply an 8% of that loan, I'll be getting interest of 8,000. So out of this 36,000 that the business has earned, that Lai Yee has earned, 8,000 will be distributed among creditors, that is loan providers. So 36 minus 8, this left us with 28,000 of net profit. If I divide the net profit with the sales figure, sales is 600,000, I'll be getting a net profit margin. Basically the answer is coming 4.67, but as we are told to round off to the nearest decimal place, instead of writing 4.67, I'll be writing 4.7 altogether. Okay, so what does this 4.7 means? 4.7% means, my dear students, that out of $100, $4.7 is our net profit. So the more the net profit margin figure, the better it would be for the business. Okay, so if the gross profit would increase, definitely our net profit would also goes up. Then we have ROCE, ROCE, return on capital employed. So the formula is return in the numerator and capital employed in the denominator. So what is basically return? Return is profit. So the question here arises, what profit will be given, will be taking, whether it will be profit before interest or whether it will be profit for the year, that is after interest. So you must remember one thing, in all of the ratios that we have studied till yet, only one ratio is it, that is return on capital employed, that will be using profit before interest. Instead, all other ratios would use profit after interest, that is profit for the year. Only return on capital employed is the only ratio that will be using profit before interest. So profit before interest, also known as operating profit, we have already been given, that is 36,000. This 36,000 should be divided with capital employed. Capital employed consists of our own money, that is owner's capital, and also the funds that we have borrowed from outsiders, that is loan providers. So our own capital, that is owner's capital, is 200,000, and then the loan that we have taken out from outsiders, that is bank loan, is 100,000. But you must remember, the loan would be non-current liability. If we are being giving a short-term loan or an overdraft, that would never constitute part of capital employed. Okay, capital employed contains only owner's capital and non-current liability, and never we use current liability in a capital employed. So basically, the total amount of money that has been invested in the business is 300,000, out of which 200,000 is our own money, that is owner's equity, and 100,000 have been taken out as a form of loan from outsiders. So the total amount of money that we have invested is 300,000, and out of that 300,000, 36,000 is the profit that we have earning. So if the denominator contains total capital for us and for outsiders as well, therefore the numerator should contain the total profit, that is profit before interest. We will not need to deduct interest here, because we want to know about the total profit of the business, that is which contains our share as an owner and which contains the share of outsiders. So the total return would be 12%. That is return on capital employed. Now, instead of return on capital employed, if we would have been asked by examiner to calculate return on equity. Now, what would have happened if the examiner has asked on return on equity, also known as return on shareholder funds, ROSF. Return on shareholder funds or return on capital or return on equity means the same thing. If we have been asked to calculate return on equity, so the numerator now would contain only profit that belongs to owners, only profit that belongs to shareholders. So we'll be taking now profit after interest, which is known as profit for the year as well, and divided by denominator that contains only owner's equity. My dear students, I'm trying to explain you that if in the denominator we'll be using owner's capital only, then in the numerator we'll be using only profit that belongs to owners. Okay, only profit that is belong to owners, that is after deducting all sort of interest. So if the profit that we have is 36, and out of that 36 we deduct the loan interest, that is of 8,000, will be left off with the profit that is purely related to owner, that is 28,000. So the denominator would also contain only owner's capital, that is 200,000. So the owners have earned 28,000 on their investment of 200,000. So this would become 14% in this question. Although return on equity was not asked in the question, it was not required, but I've just calculated for the sake of understanding of you guys. So what is the difference between return on capital employed and return on equity? In the return on capital employed figure, a denominator contains both of the capital, whether it is of owner or whether it is of outsiders. So if the capital is combined, total capital, so the profit would be total, that is before deducting interest. If we are required return on equity, so the capital would be purely for owners, that is owner's capital. If the capital is belong to owner only, so the profit would be also owner related, that is profit after interest. I hope you got the point. Then we have a current ratio required in the question. Current ratio, formula for current ratio is current assets upon current liabilities. Although we are not expected to write the formulas in the exam, that will not fetch us marks. Only thing that is required by us is to show the workings, okay? Workings are important and the formulas are not. So current assets divided by current liabilities. Current assets are assets that are short term in nature and that are cash or bank, and anything that would be converted into bank. So at the end of the year, we have current assets of 45,000, that is trade receivables, we have 45,000. Then what other current assets can we find out in this question? We have a bank balance. If the bank balance is on debit, means it is a current asset. If the bank balance would have been credit, it would have been a current liability. Then we have a closing inventory figure that is of 75,000. As all of the ratios are being calculated at the end of the year, therefore the inventory would also come as closing inventory and not the opening inventory. If I add up all of the current assets and divide it by current liability basically contains trade payable, and alternatively there can be other payables as well, and there can be bank overdraft as well. So if I divide current assets with current liability, the answer that I am getting is 3.6. Okay, if I am working on one decimal, the answer is 3.6. Now I wouldn't be writing only 3.6, and what I'll be doing, I will be complementing it with a ratio 1. So what does ratio 1 means? 3.6 ratio 1 means for each dollar of current liability, we have current assets worth $3.6. So this 1, my dear students, represents the denominator, that is current liability, and this 3.6 represents the numerator. Means if we have $1 of current liability, we have $3.6 of current assets in order to settle this current liability. Now the question here arises that what should be ideally our current ratio? So as we can compare, we can comment on the performance of the business, whether the performance of the business is improving or it is worsening. So as you can see, there are three things. One is ideal, one is maximum, and one is minimum. If we go to ideal current ratio should be 2:1. What does this mean? This means for each dollar of current liability, we should have current assets of $2. If the current assets are more than $2, we would say the ratio is not at the ideal situation. So the minimum should be 1.5 and the maximum should be 3. So these are the benchmarks that you should remember so that you can comment on the performance of the business, whether the performance is improving or deteriorating. So ideally it is 2, minimum should be 1.5. What does this mean? If the current ratio falls below 1.5, this means the business is in the danger situation. It is an alarming situation of the business, and business is prone to bankruptcy. Okay, business is vulnerable and it can be bankrupt sooner or later. It can file for liquidation. It can go out of business. So if the current, if the current ratio is more than 2, what is the problem with us? The problem is that it should be maximum to 3, and if it is more than 3, you can comment that the business is losing its resources. Okay, the resources are being underutilized and resources are being idle, ideally. Okay, ideally the resources are wasteful and they are not fully utilized. So ideally there should be, ratios should be between 1.5 and 3. Okay, so if it is on 2, this is the best you can get. Okay, and the maximum should be 3. If it's going above 3, you may write that the business is not utilizing its fund properly and some funds are idle, and if it's below 1.5, but if you can see in this question, it is above the maximum range, so we can say the liquidity is sufficient and it is more than it is actually required. Well, why shouldn't be the liquidity more than 3? If the liquidity is more than 3, we can say that this money is being wasted and this money should have been invested somewhere else, maybe in the non-current asset, maybe in new projects, maybe in plant and equipment, so as to yield more return than it is presently earning. As you may be aware, if the money is just lying in the banks, in the current accounts, it is not earning any interest to us. Okay, so this money is of no use to us, and although it will help in covering our liquidity. But if the liquidity is very low, if our liabilities are very low, and we have current assets of very high, so this would have no use to us. Now let us move further. In the B part, again we are required to comment on the liquidity. Now before commenting on the liquidity, before moving on to B part, let us discuss, although in this question we are not being required to calculate some other ratios such as receivable days, but I have nevertheless solved this for you so as to have some practice regarding these new ratios that have been added to examination syllabus for CAIE's 7707 O-level accounting. So receivable days we can also calculate if it is required in the question, although it's not required here, but I am calculating it for you. Receivable days, first of all, you can see the formula. Formula is trade receivables upon credit sales into 365. Trade receivables upon credit sale into 365. So why do we calculate the receivable days? The receivable days basically tell us that how much time on average our customers take to pay us the money back that they owe to us. Okay, so this is also known as the receivable correction period. If you can see at the end of the year, trade receivable is 45,000, and the credit sale, although we are not given about the credit sales, we will assume that all of the revenue belongs to credit sales. If the examiner does not mention the cash sale, this means all of the sales is on credit. Okay, then we'll be multiplying it by 365. Why? Because there are basically 365 days in a year. So if I solve for this, the answer would be maybe 27 point something days. Let me solve it for you. The answer that is coming is 27.3 days. So instead of writing 27.3, I'll be rounding off to 28 days. Now, although my dear students, the rule that we have studied in maths is 1.1 is basically 1 and 1.9 means 2. So whenever we go to 1.5, this means if we want to round off, this should be 2, and if it's 1.4, this would be 1. Okay. But the problem here is it that we are working on days. If we are working on days, whether it is 1.1 day or whether it is 1.9 day, both will be constituted as 2 days. Why? Because the date has already changed. Now, you must be heard this example from me earlier also. If there is a new year and you can see at 11:59 p.m., as soon as it arises that there is a 12 a.m., so the dates change in the calendar and the fireworks starts to blow. Why? Because the new day have already arrived and there is a new year. Similar is the case with your birthday. As soon as the clock shows 12 a.m., the date is changed and you start receiving your messages from your loved ones about happy birthday. Okay, so this is the case. If there is 27.1 day, means we have already entered in 28 day. So you must remember, whenever we are solving for days, whether it is receivable days or it is payable days or it is inventory days, and if it's in days, 1.1 days should also be round off to 2 days, or 1.9 days should also be round off to 2 days. Therefore, I am done with 28 days in this question. So what does 28 days means in this question, my dear students? 28 days means on average our customers take 28 days to pay us the money. Now the question arises whether receivable days should be less or whether it should be more. Now there are two things to consider in this. One is liquidity of the business and one is profitability of the business. So basically this is a liquidity ratio, receivable days or payable days. So we are more concerned with liquidity when calculating receivable days. So receivable days should be less as we are talking about the liquidity. If the receivable days is more, if the customers take more time to pay us the money that they owe us, then we will be having some liquidity problems. Why? Because if the customers have not paying us on time, there can be problems relating to liquidity. Will be out of cash. Secondly, the customer can go bankrupt. If the customer can go bankrupt, it will be bad debt for us. Therefore, it will be bad for our profitability as well. But there is another aspect of this as well. And the other aspect of this as well is of profitability. And what is that? If we initially allowed our customers a credit period of maybe how much days? Maybe 45 days. If we allowed them 45 days of credit, now instead we are recovering the money from them in 28 days, then customers won't be so happy. Why? Because the customers will feel betrayed, and they will feel that initially we allowed them 45 days of credit. Now instead of granting them full 45 days length of credit, we are pushing them harder so that they can pay us the money early. So therefore we will be also losing, we will also need to pay discount allowed to them. This is also an expense for the business, and the customers will be angry, they will be annoyed, they will try to move their business to some other supplier. Okay. So therefore it would be good if we give them the full credit period that we have already suggested them, we have already allowed them, so that they do not join our competitors, so that our business is not lost. Okay. So there are two aspects to this. One is liquidity. From liquidity perspective, receivable days should be as short as possible. But from the profitability, long-term growth of the business perspective, it should be somewhere around that what we have allowed to our customers. Then what else do we have? We have some other things. We need to comment on the liquidity of the business. We need to comment on the current ratio. We have already discussed that part, that current ratio is high or sufficient. Why it is high? Because it's more than the maximum range, that is 3:1. Well above the yardstick. Yardstick means benchmark, thing that we use to compare. Okay, yardstick. When one of you goes to a nutritionist and you say that can you tell me that am I overweight or underweight? Now they have some sort of chart, they have some sort of BMI, body mass index formula. They will ask you your age, they will ask you your weight, they will ask you for your height, and after calculating something, they will give you a verdict that you are overweight or you are underweight. Okay, because they know their game, they know whether you are overweight. This is the yardstick that they are using to compare. Then there are some idle funds or unutilized funds, because it's more than 3, so therefore we are writing in comment that some of the funds are underutilized. Now as you can see in the next part, that is C part, the question states, I'm reading the question, Lai Yee is considering ways in which she might improve her ROC. Basically what we want to improve our return on capital employed. We have basically suggested 4 proposals so as to improve our ROC. We need to comment on whether these proposals would increase or decrease or would have no effect on our profit, and similarly the case with the capital employed. Now let us first see the first proposal that have already been solved for us, but let us see what does this means. Introduce additional capital of 10,000. My dear students, if you are introducing additional capital now, so right now there would be no effect on profit. Why? Although it will be long-term effect on profit of investing some money, more money into the business, but right now in this transaction the entry would be bank debit and capital would be credit. So this would not directly immediately affect our profit, therefore there will be no effect on profit. And as you may be aware that owner's capital is part of capital employed, and if the owner's capital is increasing, so capital employed would also increase. Now second proposal that we are given in the question is to repay half of the 8% bank loan. We have a bank loan worth 8%. If we repay half of the loan, therefore we only need to pay interest on the other half. As you can see, we have a loan worth $100,000. Now right now we are paying interest 100,000 multiplied by 8%, that is 8,000. If we repay half of the loan, then only the loan that we are left with is 50,000. Now 50,000 multiplied by 8%, it would be 4,000 only. So now our interest is reduced by half. As you know, interest is an expense for the business. If the expense have been reduced, then the profit would also increase. Okay. If the expense is decreasing, then the profit would be increasing. Now what about capital employed, beta? Capital employed is basically our owner's capital and our loan. If the loan goes down, so our capital employed will also goes down. Both of the things are included in capital employed. It's owner's capital and loan. Then what else do we have? Other than that, the next requirement that we have in this question, the next proposal that we have is sell $20,000 non-current assets, saving $3,000 in depreciation. Okay. If we are selling assets, our depreciation will be less than it was previously by 3,000. Because depreciation is an expense, if we reduce our expense, it will increase our profit. It will have good effect on our profit for the year. So the profit would increase. If we sell non-current asset, the entry would be basically bank would be debit and non-current assets would be basically credited. So one asset is going up, that is bank, or one asset is going down, that is non-current asset. So therefore, there would be no effect on capital employed. So the capital employed would be unaffected. Capital employed would be unaffected. Now finally, beta, in note number 4, we have to convert $25,000 of the 8% bank loan into a bank overdraft at 12% interest per annum. What do we need to do? We need to convert 25,000 of the 8% loan into overdraft. Okay, so we are paying off the loan and instead of loan, we are taking an overdraft. So as you can see, previously the loan was 8%. This means we need to pay bank 8% on the loan amount, and out of that 8%, we have returned this 25,000 amount, and instead of that, we have taken out an overdraft that is 12%. So if the interest goes up, this means our interest expense also goes up on this 25,000 by 4%. If the interest expense goes up, this will reduce our profit. Okay, this will decrease our profit. And as you may be aware that bank loan is basically part of capital employed, but bank overdraft is not a part of capital employed. Why? Because bank loan is a non-current liability and overdraft is not a non-current liability. Overdraft is a current liability. So if bank loan is going down, our capital employed will also goes down. Why? Because owner's capital plus non-current liability, this becomes capital employed. There is another requirement in this question, that is D part, which says Lai Yee, that is owner, is also considering improving her profit for the year by. So Lai Yee basically want to improve her profit by hook or by crook. Then she has suggested 2 proposals, and we need to find out name which accounting concept would not be complied. Which accounting concept would be violated if Lai Yee implemented a proposal? Now, first of all, we have a proposal, and what is the proposal? Revaluing her premises to the market value of 120, the cost is 100,000. My dear students, whenever we are revaluing our asset, any asset, whether it's non-current asset or whether it is inventory, so which accounting concept is basically violated? It is a historical cost concept. Historical cost concept basically says that it states that any asset should be kept on the original cost. Original cost is basically the cost that we have basically incurred in acquisition, in buying that asset. This is a historical cost. So whenever we are keeping the asset on more than the value that we have actually bought, or maybe less than the value that we have actually bought, so this is basically a historical cost concept. Then in the second proposal, we are asked to remove the provision for doubtful debt. As you may be aware, provision for doubtful debt is supported by basically 2 concepts. One is prudence and one is accruals and matching. Prudence we can also write prudence, and we can also write matching concept. So how can be prudence? Prudence concept states that we must immediately record our expenses or losses. We should not wait for them to materialize. So if we are recording provision, it is an application of prudence concept. And if we do not apply, if we do not make a provision, therefore it will also overstate our profit and assets. Prudence also states that we must never overstate our profit for the year, and we must not overstate our assets. So if we are removing the provision, this would decrease our expenses, and in turn that will increase our profit. Similarly, it will also increase our current asset, that is debtors. Okay. So my dear students, I hope you were able to understand the underlying concepts behind ratios analysis with the help of this simple question. To watch more of such lectures, you must subscribe to my channel Ahmed Raza Dharolia. Thank you.